Hello friends, welcome to my YouTube channel at One Raj Kamal. As you go through this video, please do subscribe and press the bell icon so that you can get intimations on new videos as they are put in. Markets continue to be bullish this week. In fact, the streak has been pretty strong since the lows of mid-June. See this chart where you can see that all major indices have rallied hard since mid-June, and Dow Jones is up 12.81% since then. S&P 500 16.73% since then, and Nasdaq by more than 22% at about 22.55%. See this another chart, and this shows sectoral performance since mid-June. All sectors have been bullish. Consumer discretionary is up 26.5% and tech is up 22.28%, and that shows that risk on is back. Then real estate and utilities are up both over 18%, and that is driven by pullback in dollar strength. But also industrials, financials, healthcare, staples are all up between 10 to 15%, and that indicates a broad-based recovery, which is pretty impressive. Crypto markets have also been very strong during this period. Over the last month, Bitcoin has been up over 18%, ETH a whopping 67%, Matic 41%, Avalanche 49%, and Solana 27%. And the drivers for all of this rally is a mix of too much negativity having been priced in, peak inflation narrative, pullback in 10-year yields, and the Q2 earnings faring better than the worst that was expected. So overall, great, last 40-45 days for the markets. The biggest news in the last week was the CPI report that came in. July CPI was lower than estimates, and 12-month inflation is now at 8.5% compared to 9.1% in June. Core inflation, which excludes food and energy, came at 5.9%, lower than estimate, but it was flat compared to June. Key driver of the decline in the headline CPI was a minus 4.6% reduction in energy inflation as the price of oil has come down. However, food index was up 1.1% for the month of July compared to 1% in June, and is up a whopping 10.9% year on year. And all items ex food, shelter and energy are up 6.1%. Markets saw this as a confirmation of the peak inflation narrative and rallied hard. In fact, immediately after the CPI announcement, the odds for a 75 basis points hike in the September meeting of the Fed came down and is currently even Stevens with the 50 basis points rate hike odds. Question still remains that whether a 5.9% core inflation rate or a 6.1% inflation rate ex food, shelter and energy is an acceptable rate, and whether it is sufficient for the Fed to pivot from its hawkish monetary policy stance. This is to be seen. As we talk about Fed and inflation, liquidity is an important thing to look about. I want to point your attention to yield curve. Yield curve continues to be massively inverted. See this chart where you can see 10-year minus 2-year, and that is at minus 41 basis points, which is the highest negativity in the last 3 decades. See this another chart where you see 10-year minus 3 months, which is also flirting with inflation. It's at 21 bips currently, but had come down to 4 bips in early August. If indeed the Fed hikes by 75 basis points in its September meeting, 10-year minus 3 month could very well invert. And we all know that an inverted yield curve means liquidity challenges because financial institutions and banks are not incentivized to lend or provide liquidity for the long term because the short term rates are very high. Another picture is the Fed's balance sheet. Now see this chart and you will see that the Fed's balance sheet has hardly reduced and it's still around $8.9 trillion. But starting September, the Fed will begin to shrink its balance sheet more aggressively by about $95 billion every month. This will include a $60 billion reduction in US Treasuries and $35 billion reduction in mortgage-backed securities every month. This would be a first of its kind. A very aggressive rate hike in which 200 basis points have already been increased in the Fed funds rate in the last 2 months, and another 50 to 75 basis points priced in for the next meeting. And that is being followed immediately or concurrently by a very aggressive balance sheet reduction program. Now, some people will look at, the picture of overnight reverse repurchase agreement, and here is the chart. And this chart is interesting because it shows that banks are already parking in surplus liquidity with the Fed. See here that nearly $2.2 trillion worth of liquidity is being parked by banks and financial institutions in the Fed. So technically, the Fed could shrink its balance sheet by over $2 trillion and liquidity would still not dry up. But just step back for a minute and ask yourself some questions on what does it mean. Well, liquidity hasn't fully dried up. Core inflation is still very high. And if the markets are assuming that the inflation problem is over, they may be ahead of themselves. Second, liquidity reduction is very much a reality. We are likely to face liquidity challenges as the Fed continues to shrink its balance sheet and continues to be on a rate hike plan, even if it's not as aggressive as the market thought it would be earlier. But any liquidity reduction path or liquidity squeezing path by the Fed has never been bullish for stocks in the past. Having said this, there is always a question of, is the bottom in for this cycle? Now, look at this chart of S&P 500 and you can see that the rally since mid-June has been pretty strong. In fact, S&P 500 has breached an important technical level at 4170. That was the lows of the Fed March pullback and the highs of the early June rally. The next resistance is clearly the 200-day moving averages ahead. But the S&P 500 has retraced more than 50% of the total decline from the all-time highs. This is really massive and it's been broad-based across sectors as I showed you earlier. This therefore means that while I do expect markets to continue to be choppy and roll over given that liquidity will be a challenge and inflation is not fully sorted out, it is quite likely that the lows of the cycle have been reached in June and the bottom is in. Thank you.